Hey everyone, welcome to the first video in this mini-series on hedge funds. In this tutorial, we're talking about hedge funds generally and what they are. We're going to talk about some of the strategies as well as some of the things that you can look for. Be sure to visit the Rask Finance website where we've got many more videos like this on investing and finance in general, and we'll be able to answer your questions there. So firstly, what is a hedge fund? Now I've drawn a pretty little picture over here of, well, I think it's pretty, of a hedge, like a garden hedge. And what you'll notice about this hedge is that it's flat. Now, I don't know if it takes its name from this, but it's a neat analogy, right? Like you've got the hedge, it looks pretty flat. That's generally a good sign. When you talk to a gardener, I'm sure they'd say a flat hedge is probably the best way to go. So how does that relate to finance in any way? Well, if you look at a share price chart or you look at the market like this, what you'll notice is there's a lot of bumps and down periods, and then there's times when the market goes up and then it crashes and then it goes up again. Well, people don't like to experience these little bumps, funnily enough. And what a hedge fund tries to do is it tries to minimize the risk associated with investing, but also benefit from the up periods. So they try to protect against risk. So a hedge fund, as opposed to a traditional managed fund, and we've got a video on the Rask Finance website about managed funds, a hedge fund can bet on both up markets and down markets. So they can profit from investing in shares that go up and shares that go down. And it's not just shares, they might invest in property, infrastructure, bonds, debt, anything really. A hedge fund, depending on which one you're looking at, they can come in many different flavors and sizes. So what exactly am I talking about? So a normal managed fund that invests only in shares, and they must write out all of the bumps, would experience all of these types of movements, right? So they would experience the good patch, like this bit through here, but they would also experience the bad patch, like this bit through here. So a hedge fund can potentially, and I say potentially, it doesn't always work, they can potentially make money in both of these environments, because in this market, which I've circled in green, they can make money from the share price going up, but they might also be able to what we call short the shares. So they might be able to make money when the share price goes down. Now this is just one example, and they can do different types of strategies, but that at the end of the day, that's what most hedge funds do, is they try and take positions to mitigate risk, but also maximize return. Now, bigger picture is that they don't always work. Some hedge funds have really good marketing, and the strategy makes a lot of sense. It's, it could be really, quantitative, and there's a lot of numbers, and there's a lot of proven back tests, and everything looks really good. But in reality, it doesn't work. Now, some hedge funds get it right and they do really well, or they might be really good for 1, 2, or 3 years or 5 years, but few have shown the ability to go over very long periods of time and really do well against the broader market. So what are the types of strategies? Some of the most common are what we call long-short funds. So just like I said here, a long-short fund can take long and short positions. So a long, for the purposes of this video, is anything that you buy and increases in price. You take the position that it increases in price, you are long, and you can make money from that thing increasing in price. Short is when you make money from when things go down. We've got a more specific definition on the Rask Finance website, but that's all you really need to know for the purposes of this video. So they're a long-short fund, so they can make money effectively when share prices rise and when they fall. Another one is a market-neutral fund. And this is a type of strategy where they try and neutralize the movements of the market. So if you go back to our hedge analogy, and that's flat, a market neutral fund, instead of looking like just like a perfectly flat line, what they try and do is they try and do this. So you might be able to see that blue line there. It's still a flat line, but they try and tilt it upwards to capture the natural upward trajectory of the market, but they also try and mitigate the risk associated with the bouncing around of the market or the volatility. So there are two common strategies. Another one is what we call merger arbitrage, which is where you take positions in takeovers. So you might buy a share before it announces a takeover, or after it's announced a takeover, to try and make a little bit of money. There's many different ones. There's multi-strategy, there's macro funds which bet on economies, there's hedge funds that operate only in bonds or commodities like gold or oil or anything like that. Really anywhere that something can be traded and made money from, a hedge fund would probably be there. Okay, so the risks, as I've alluded to in this video, they don't always go right. Hedge fund strategies don't always work out. Now, so these are generally when you walk in the room with a hedge fund manager, they're the smartest person in that room, and they can throw some pretty impressive marketing documents at you, and they can wow you with a lot of their understanding and knowledge of investing. But few fund managers actually go the distance and can create exceptional amounts of money for very long periods of time. Now, there are some, but what you generally find is that those that do really well or have really good track records charge a lot of fees. So whereas in a traditional managed fund, the fee structure might be, I suppose, less harmful to your long-term financial or long-term wealth, and a hedge fund can have quite exorbitant fees, particularly the ones that are really good. So you do have to pay up to get into them. Now, there's no way to know for sure whether they're going to do well. So of course you would choose the one with the lower fees, but that's why it's always good to, when you are investing in a hedge fund, to maybe think about diversification and putting your eggs in multiple baskets rather than just with one hedge fund. So I hope that provides a primer on hedge funds. In the future videos in this series, we'll explore some of the strategies, but also some of the other things that you can look out for. And as always, if you have more questions, head to the Rask Finance website and we'll be more than happy to answer whatever we can. I'm Owen Raskovich, and cheers to our financial futures.